Hi everyone, welcome to Investing Club. In this video, I'm going to be showing you what I believe to be one of the most undervalued parts of the stock market right now. Now, before we start the video, I am not a financial advisor, and this should not be considered financial advice. You should always do your own research and talk to your own financial advisor before investing, and this is just an idea that I am presenting to you. So here we are on FinViz, and a thing I really like about this website is you can go to the Groups tab. This will give you a summary of the performance of all of the different sectors in the stock market over various time periods. And so we see the 1 day performance, 1 week performance, 1 month, 3 month, and half year. And so what I usually like to look at is the 3 month to the 1 year performance to see what industries are doing good and what industries are not. Because in the industries that are not doing good is where you will likely find the most undervalued stocks. So if we take a look at 3 months, what has been underperforming? It has been energy, it has been real estate, and financial are the three worst sectors. And over the half year, it's again the same thing, energy and financial. And in the 1 year relative performance, energy and financial are the two worst sectors. And so for that reason, to me, the financial sector is one of the most attractive sectors to me right now to invest in. And specifically, I think small cap bank stocks are severely undervalued. And so we can narrow this down even further to within the financial industry. And we can scroll down a little bit, and here we go. 3 month performance. What has been the worst performer in the financial industry? Regional banks. In the half year, same thing, and 1 year, regional banks. So regional banks have been lagging. So the financial industry has been lagging the rest of the stock market, and within the financial industry, regional small cap banks are the ones that have really been lagging in this sector. And I don't think it's justified, and for that reason, I think that these banks are the most undervalued part of the stock market right now. So for bank stocks, you can't value them the way you value most companies. And so a common way to value bank stocks is based on their tangible book value. And the tangible book value per share is basically all of the bank's tangible assets, their buildings, their land, what they own. And by looking at the tangible book value of a bank, you will be able to see what its true worth is. And right now, a bunch of banks are trading at huge discounts to their tangible book value. Now, this article from MarketWatch highlights a few of them. These bank stocks trade at discounts of up to 54%, and Wall Street loves them. And so below is 11 buy-rated stocks trading below their tangible book value. And here's the list. And you can see price to tangible book value, one of them is 56%. So these banks are severely undervalued. And we see Bank OZK is one of them. That's the bank I'm invested in. It is only 76% of its tangible book value. And so why is this happening? Why are these small cap banks trading at crazy discounts? It's because of a fear of another financial meltdown. Because the last memory in people's minds is the 2008 Great Recession, and that was caused by banking. But banks today are put together much better than they were in 2008 and 2009. Today's banks operate with 25% leverage than 12 years ago. And these banks have had much lower loan to value ratios for commercial real estate loans. So these banks are severely deleveraged from where they were in 2008 and 2009. Again, here's another list of all of these banks that are trading below their tangible book value, and a lot of them are providing huge dividends. And so I think this has caught the attention of some investors, and we can see that these regional banks have recently started surging. In this past week, 324 out of the 359 regional banks were up. So this is a sector where I think a lot of money is starting to flow to as people realize that these stocks are undervalued. So what I'm going to do, I'm going to show you 3 small cap regional bank stocks that I think are very undervalued at today's prices. The first one is Bancorp, ticker EGBN, and this bank mainly operates in Maryland and Virginia. And so taking a look at some of the metrics, their price to book value is under 1, which again signals it's undervalued. Their price to cash is only 1.06. So this bank pretty much virtually has as much cash as its entire market cap right now. Their forward PE is under a 9, and they have pretty low levels of debt for a bank. And they pay a 2.7% dividend. And their payout ratio is only 22%. So the dividend is covered well by the earnings. So even if they say a huge drop in earnings, it's likely that they'll be able to keep this dividend. And this is a quality company with a long history of growing earnings. We can take a look at their historical earnings per share, and this goes back all the way to 2006. And we can see that almost every year this company sees an increase in earnings. In the past 3 or 4 years, that growth has tapered off a little bit, and that's just because we are at the end of a market cycle. But starting a new market cycle, these banks should be poised for high growth over the next decade or so. And so the PE ratio has been falling for this bank. This bank currently has a PE ratio of 8.2, and we can take a look at where it was at the bottom of the financial crisis, and it was, again, 8.62. So this bank is being valued the same as it was during the peak of the financial crisis. The lowest that this bank was valued back then, that's what you can buy it for now based on earnings. The second bank is CIT Group, ticker symbol CIT. And so this bank currently pays a 7.7% dividend. I don't know if they are going to cut that or not. It is likely that they will either reduce the dividend or cut it temporarily. But the thing about this bank is how undervalued it is based on its tangible book value. We can take a look at this website, and over the past 10 years, their price to tangible book range, the median is 0.98. Banks are usually valued based on their tangible book value, and the price is usually equivalent to the tangible book value per share, which has been the case with this company. But right now, we see that their price to tangible book value is only a 0.35. So if you use tangible book value as a method of valuation, this bank is valued at only 35% of its true value, which just screams undervalued. So if we saw the fear over these banks subside, we could easily see this bank go right back up to where it is fairly valued. And the last bank in this video is Bank OZK. And of course, I have a large position in Bank OZK. I made a full analysis of the stock. So if you want to watch that, I will put a card up to it right now. But again, the things I love about this bank are the price to free cash flow is a 6, which again, for stocks, I like to look for a price to free cash flow of under 10, and this definitely fits that. The price to book is only 0.7, so again, undervalued based on that. And their PEG ratio is low. This is still expected to grow at 12% a year, and right now the forward PE is only a 10. They currently pay a 4.8% dividend, and they recently increased that dividend. So I do believe that they will keep paying the dividend and increasing the dividend throughout the next couple of years. Again, just to take a look at this bank's history, one of the things I love about this bank is their strong operating history. And you can see earnings per share growing very consistently since 2006. And again, the earnings have tapered off in the past couple of years because we are at the end of the market cycle and expansion is slowing down. But this huge shrinking in the PE ratio is definitely not justified. They are currently trading at a PE of 8.8, and at the financial crisis, they were at 6.75. So this bank is valued almost as low today as it was during the worst of the 2008 financial crisis. So assuming we don't have a total meltdown in the banking sector, I suspect all of these banks to recover quite nicely. Now, there's a lot of people that don't feel comfortable investing in individual stocks because they don't like the risk they're taking, and that makes sense. So if you are someone who invests in index funds, this is an option that could be for you. It is the Spider Regional Banking Index, and the symbol is KRE, and this is an ETF that carries a basket of these small cap banks. So if you're not comfortable investing in any one or two of these small cap banks, but you agree with my view that this sector will recover, then this is something you could take a look at. At the beginning of this year, they were trading at around $58, and they are down 34% since that point, and they are now at $38. And this ETF pays a 3.5% dividend. And again, it's likely not to be cut very much because this contains a large number of these regional banks. So even if a couple cut their dividend, it will still keep the dividend from the rest of the banks that are still paying them. And the PE ratio of this ETF is a 6.5. So this basket of stocks is being valued extremely cheaply, and I don't expect it to stay this way for long. If we keep seeing the economy recover and make it out of the shutdown we just went through, then this could be the next industry to really go up big. Again, this is just my opinion, and so if you are interested in this, I would definitely recommend looking into it further. I won't be buying this ETF because, as a lot of you know, I have a large percentage of my portfolio in Bank OZK, so I think I am plenty exposed to the small cap bank industry. But if you're not, then this could definitely be something to look into that could help diversify your portfolio where companies are still being undervalued. If you like what you saw in this video, hit the thumbs up button, subscribe to the channel for more videos like this, and I will see you on the next video.